Clearly, the Fed tightening cycle creates risk for high PE stocks globally, but the biggest risk, I think, relates to the US market, because the US market has been the most expensive market, and the source of the inflationary pressures we see today are primarily in the US and other G7 countries. They're not in Asia, be it China or be it India or other areas of the emerging markets. And the difference is very clear, because the relative lack of inflationary pressures in Asia reflects the different policy response to the pandemic. When the pandemic hit in early 2020 in the Western world, there was gargantuan monetary and fiscal stimulus, which led to a lot of people in those US, Europe, or UK being paid lots of money to do nothing. That created artificial demand, which has stimulated these inflationary pressures. In Asia, that did not happen. So you've had significant fiscal easing in India, for example, but my understanding is that most of the fiscal easing in the budgets we've seen in India have gone primarily to boosting Capex in infrastructure, not in transfer payments. Okay. So I think there's a fundamental difference. But the key issue really short term is how much the Fed really tightens. And we will get buffeting in markets from that. There will be more tightening corrections. Another key issue relates to the Fed balance sheet. Does the Fed just do rate hikes, or does it start contracting the balance sheet? If it starts contracting the balance sheet in a meaningful way, that will make markets more nervous. So it's entirely logical for India to see corrections, because India is expensive in an emerging market context. But what's very encouraging so far in India is that I've seen significant foreign selling of Indian equities year to date, but the market has been supported remarkably well by continuing domestic flows in India. So that's very encouraging to me. To me, I'm more relaxed on that issue, because the general election is still a long way away. Mm-hmm. But I think on the oil price, that is definitely the biggest. There's two external risks facing the Indian stock market this year, primarily in my view. The one is obviously the Fed tightening, which we discussed, but the other is the oil price. And in my view, the oil price, in a world where we don't get a more lethal variant relating to the pandemic, and we return more and more back to normal, I think the oil price is going still higher. And the key thing driving oil is demand coming back after the pandemic, combined with extreme supply shortages. And these supply shortages reflect the political attack on fossil fuels in recent years, which has created a big disincentive on the part of the energy sector to invest in new production. So the world is now dealing with the price consequences of its stated desire to undergo energy transition. The problem with this energy transition agenda is many of the people advocating it have not really been focusing on the fact that in 2020, which is the last data we had, 83% of world energy demand was still met by fossil fuels. I know, like, to me, a key issue, both for me and my colleagues in the Indian Jefferies office, we've been very focused on the residential market, because you need evidence of a new investment cycle in India. And what's been extremely encouraging in the last year is that we've now finally have evidence of a residential property market upturn in India after a very extended 7-year downturn, which led to brutal consolidation in the property sector. And my view is that the base case is that now that the residential property cycle is underway and affordability remains very good, and we've got a lot of pent-up demand, my base case is this cycle should run for 5 to 7 years. So I've written in the Greed and Fear, my colleagues have made the same point, that it looks to us that India is in a very similar situation to where we were back in 2002, 2003, which is the last time we began a residential property cycle in India. And that was followed with a 12, 18-month lag by a broader Capex cycle. I'm hoping the same dynamic kicks in today. If it does, Indian economy and Indian market is going to prove much more resilient in practice to higher interest rates in India, just as was the case back in the 2003, 2007. I think this RBI is more dovish. The RBI in this current government, current leadership is more dovish than the predecessor. But in my view, the RBI was for an extended period there too hawkish, and you had too high real interest rates in India. So what's again very encouraging so far is, despite the relative dovishness of the RBI, that I would have to emphasize, the RBI has been nothing like as dovish as the Fed, the ECB, or the Bank of England in the last 2 years. But in the context of that relative dovishness, and in the context of the high oil price, what's encouraging is that so far the Indian currency has been relatively resilient. I was very bullish on energy stocks last year, and I remain, and the year before, and I remain bullish on energy stocks now because of this massive supply constraint in the oil market. In the short term, if this Russian-Ukraine situation is resolved, oil will correct, and then I would advise people to add to their exposure to energy stocks. What's incredible about oil is it's up at these levels today, even with much of Asia remaining closed, including China. If the whole world really reopened, oil could go much higher. So actually, to me, oil is the biggest single risk in the Indian market. And I would urge investors in India to hold energy-related stocks to hedge that risk, as well as globally. So the best performing sector in the S&P last year was the energy sector, not tech, not FANGs. The best performing sector year to date in the S&P, when I last checked, is the energy sector. No, that definitely can go against India in the short term, because emerging market investors will be tempted to take money out of India because it looks expensive because of the Fed tightening risk, and they'll want to put more money into China because China's easing. Also, the Chinese market is much more defensive on a relative to Fed tightening than India. The reason why is because the Chinese tightened last year, and the currency, the renminbi is rock solid. So if the market's correct on Fed tightening concerns globally, China will outperform. Well, I think the obvious areas that benefit from energy transition and EVs, etc., are copper and nickel. So I think it makes sense to be positioned in these areas long term. Personally, this energy transition, though, will add, we've got all these inflationary concerns globally, which have been primarily driven by hugely expansionary monetary and fiscal policy in the US and the G7 world. But you also got the inflationary pressures being driven by the supply chain bottlenecks, which have been created by the pandemic. But then you have this other issue, you have this politically driven energy transition, which you may agree with it or not agree with it, but what's becoming increasingly clear is that this is an inflationary transition, as we see in these prices. Now, the crypto is a very interesting long-term story, and I have a bit of a weighting in Bitcoin, that's correct, but still much less than gold. But I would have to say that if the Fed is serious about tightening, which at the moment it appears to be, then the crypto asset class is going to be vulnerable while monetary tightening is happening, just as the high beta profitless tech segment will be vulnerable, and just as the areas like biotech are vulnerable, because these are high, long-term growth stories without a lack of profit short term. But to me, in a Fed tightening cycle, be it Bitcoin will outperform the other crypto vehicles, because Bitcoin is basically a store of value like gold, where some of these other crypto assets like Ethereum or Solana are basically equivalent to high beta tech stocks. Crypto is potentially a huge deal because it potentially has the ability to disintermediate the banking system with this whole approach of DeFi, where people are borrowing and lending money using the blockchain technology. So it is potentially hugely disruptive. But that's, to me, a 5, 10-year story. It's not in the next 1 year.